Welcome to Unit 3 of the course Modern Banking. In this unit, details on the lending aspect of the bank is highlighted. Lending is the lifestyle of a banking sector, and sound lending practices ensure not only the profitability of banks but also the stability of the financial system. Now, we'll explore the core principles and mechanisms that underpin effective banking lending, delve into credit evaluation, and discuss the tools used to manage lending credits. So first, let us see how a loan policy is formulated. A well-crafted loan policy is critical for aligning a bank's lending operations with its strategic goals. The key components of a loan policy are the risk appetite. This defines the level of risk a bank is willing to accept, balancing growth with stability. The next is the regulatory compliance. Policies must align with legal and regulatory requirements such as know your customer norms and asset management uh, lines protocols. Target market should be identified. The clear identification of target segments, be it retail customers, SMEs, or corporate borrowers, helps to focus the resources effectively. Loan pricing, that is, interest rates, fees, and repayment terms should reflect the cost of funds, risk levels, and market competitiveness. Next, we see the factors which influence the loan policy. Loan policies aren't static. They are shaped by dynamic external and internal factors. Economic conditions, that is economic trends like inflation or underemployment, influence a bank's risk appetite. The market competition. Rivalry among banks can drive innovation but also necessitate competitive pricing. The regulatory environment which is prevalent, frequent changes in regulatory norms and demand condition, constant adjustments in policies, technological advancements. Digital tools like AI-based credit scoring enhance efficiency and accuracy in the lending decisions taken by the banks. Now let us see what are the contents of a loan policy. A comprehensive loan policy addresses multiple facets of lending. So the different loan types, that is differentiating between secured and unsecured loans, helps in structuring the terms effectively. Eligibility criteria, factors such as credit history, income stability, and collateral value are critical. The loan amount limits and interest rate. These vary based on the loan type, borrower profile, and the market conditions. Now, let us see how the credit of applicants is evaluated. Evaluating borrowers accurately is very important to minimize the credit risk. So, what are all the criteria which should be taken are first, the financial history. Reviewing credit scores, repayment behavior, and existing liabilities provides insights into the applicant's creditworthiness. It's the applicant's employment and income. Stable income sources and a favorable debt to income ratio are indicators of repayment ability. Next comes the collateral appraisal. For secured loans, accurate valuation of pledged assets ensures adequate coverage in case of default. Next, let's see how a loan is supervised. So, effective loan supervision ensures timely repayment and minimizes defaults. Now, monitoring the repayments, tracking payment schedules and addressing details proactively, addressing loan performance, regular reviews of borrowers' financial health helps to identify the potential risks which are involved, early intervention, prompt actions to address distress situations such as restructuring loans or offering temporary relief can mitigate losses. Who are the credit approving authorities? So, the credit approving authority plays a central role in decision making with regard to credit approvals. So, there is a three-step process. Let's see one by one. Application review. Detailed scrutiny of the financial documents and credit reports is done as the first step. The next is the risk assessment. So, calculating the default probabilities based on borrower data and market trends is done as the next step. Finally, the approval decision is taken. This is where the policy aligning decisions with loan policy and the risk appetite in order to make a balance or the balance between the growth and the stability. So, next let us also understand what are prudential limits. So, prudential limits are safeguards to prevent excessive exposure and ensure financial stability. Capital adequacy ratio is one of the measures. It ensures banks to maintain sufficient capital to absorb potential losses. Loan to value, that is LTV ratio, it caps the loan amount relative to collateral value, reducing the risk. Finally, concentration and exposure limits. So, this diversifies lending portfolios and prevents over-reliance on specific sectors or borrowers. Now, let us also have a look at the non-performing assets. So, risk-taking and non-performing assets. Effective risk management involves categorizing loans based on their risk levels. So, how are they categorized? Risk rating system. Loans are classified as low, medium or high risk based on factors like credit history and industry trends. Non-performing assets. Let us have a look at non-performing assets. They are loans where borrowers fail to make timely payments and they are flagged as non-performing assets or NPAs. High NPA level erodes the profitability and necessitates prompt recovery measures to mitigate losses. So, to conclude, in the third chapter, we saw what are the sound lending practices which are the bedrock of a stable banking system. By adhering to robust policies through evaluation and prudent risk management techniques, banks can ensure sustainable growth while safeguarding their financial health. The dynamic nature of the economy and technology will continue to shape the principles of bank lending, requiring constant innovation and vigilance. So, with this we come to the end of the third unit. Now, to just have a recap, we saw what are all the terms which are seen by a bank for lending. What are the components of a lending policy, and we also saw why it is very important that the banks maintain some amount of LTV so that they can use it as a cover for their in case for any defaulters. In case there is a defaulter and the defaulter has not paid, it is like an insurance cover which helps the bank as a cushion. So, these are all what we saw in the third unit. Now, let us move towards the fourth unit.